Good morning or good afternoon, depending on where you are. Can everybody hear me? Okay. Thank you for joining the webinar, Harvesting Value from Closed Block Business, presented by NEOS LLC. My name is Carla Gregory, and I'll be moderating the webinar today. We are recording the webinar, and this recording will be available on the NEOS website, www.neosllc.com. This is the first in a regular series of webinars, and we will send out a survey to everybody at the end to collect some feedback. Before we get started, I want to make you all aware that our building here in Hartford has been experiencing some technical difficulties today due to construction in our area. There is a slight chance that our internet could drop during the webinar. If that happens, we will reschedule the webinar and get in touch with all the registered participants. During today's webinar, we will hear from three panelists representing the CFO, COO, and actuarial perspectives, as well as the technology and implementation view. We will leave plenty of time at the end to take questions from the webinar participants. You can submit a question throughout the webinar by typing your question in the question box on the right-hand side of your screen. So let's move along and cover some background information about closed blocks and what we mean when we use that term. Closed blocks of business, both large and small blocks, require servicing and maintenance, even though they are no longer actively sold. Our panelists will be drilling down into the various options available to an insurance company regarding these product blocks from the finance, operational, actuarial, and implementation perspective. By the end of the webinar, we hope that you've gathered some additional insight around when it's right to think about selling a block of business, how to value a block of business for the market, what other options exist for managing a closed block of business, and how to determine which option is most appropriate for your company and your particular products. Harvesting value from a closed block, regardless of size, can be realized through a variety of options. To talk about these options, we've assembled a strong panel of speakers today, each of whom brings their experiences and skill sets to the conversation. Rick Calderon represents both the financial and operational views in our discussion today. Rick has more than 20 years experience in the life, annuity, and retirement businesses. Kiri Parankiranathan brings the actuary's voice to the table. Kiri has over 25 years experience across the insurance operations with an emphasis on life and annuity product design. Ernst has more than 20 years experience in insurance and financial services industries with an emphasis on business transformation and technology modernization efforts. Ernst will speak to the technology and implementation considerations of closed block business. Remember, as we go along, feel free to submit your questions, and we'll do our best to get to as many as we can by the end. So, Rick, can you start us off by talking about the reasons a company might decide to close a block of business?
Sure. So I'm going to pretend that I'm the head of a line of business, and that my CFO just came to visit me and had a great idea. He says, Rick, I think I can save us some money. And I'd say, hey, saving money never goes out of style. I really want to know, how can I save some money? Well, this product that we have been selling, and for the purposes of our discussion, let's just assume it's a variable annuity. You know, we're really pulling out of this market, and we'd like to close this block of business down, and we want to put it into a closed block. And you know, immediately I'm both intrigued but a little bit nervous, because closing a block of business is one that can be very sensitive. So I'm assuming that there are no new sales. That would be the first thing that I've assumed. But I'm also assuming that there's a good strategic reason for doing this. Because if I don't have a good strategic reason and justification for it, I can just keep it on my shelf, and maybe market conditions are going to change at some point, and why go through the difficult process of trying to close down this block of business. So often you start the discussion off once the CFO not only tells you that they can save you lots of money, but then brings you all the data they've been accumulating and show you how much they're going to save over a period of time. And I say, great, that looks fantastic. And I look at it, and most of the savings are going to be coming from a reduction in the different functions that are no longer going to be supported, whether they're sales support, wholesale support, marketing, new business underwriting, limited customer service now, and maybe even some reduction in the in corporate unit overhead, and possibly even IT. So, that all looks good on paper, but I'm a little bit worried. And one of the first things I want to know is I want to talk to somebody from the sales area. And I may not, these things are confidential, so I may not want to go right to the field force. I'm probably just going to talk to the head of my sales and some other staff that work in the sales area and have a discussion with them to understand what's the message to the marketplace and what's the message to the other producers. Because the questions that are quickly going to arise is, well, is the company having financial trouble? Is there any reason that we should be worried about ratings? And as an aside, of course, when you close a major block of business, you're going to have to notify the rating agencies. Are there investment issues that have not been disclosed but we're concerned about? Is the company trying to send a strategic message by closing the block of business? Is this the first of many products that the company is going to cut off? And so that can lead to concerns in the sales force if you start to close things down quickly. And what's the reaction of the sales force? Are they going to lose trust in the company? Are they going to stop selling other products, not the one that we've all agreed that we want to close down? Why wouldn't the sales staff go to other companies that are going to keep a product line that I know and that I've made a good living on open? So these are all tough and legitimate questions, and if it's a core product to the company, there'll be some very sensitive discussions. With the notable exception of the collapse of the variable annuity business, the abandonment by nearly, which has happened by nearly the entire insurance sector, these issues are all relevant ones that can be managed with some thoughtful messaging. The variable annuity collapse in the marketplace was one that happened so quickly and abruptly that really no amount of messaging for companies where it was a core part of their business was sufficient. So really then I look to see, well, what do you need to do in order to close the block of business? And often these things are project plans. They take on a life of their own, and so you want to maintain confidentiality. That's the first thing, because you don't want to spook a lot of staff. You don't want to spook the marketplace outside either. So you need to seek input from a broad spectrum within the company, but you have to balance that by not going too overboard. My own personal experience is that you do need to reach out to as many people as you possibly can. And they will take it seriously, but you need to get as many people involved as you possibly can from many different disciplines, and I'll talk about some of those reasons why. Certainly you need to develop a communications plan. That's sort of right off the bat. You need to have an internal and external communication developed for all your various stakeholders. But then the mistake, and I've done this myself, of just jumping right to the heart of the cost savings, and that's the personnel reduction. Because when the CFO came to you, really what they were talking about is savings resulting from not needing as many staff as you had before. And so you will invariably need to visit with HR, and you'll have to talk about how many sales staff you no longer need, what are the marketing distribution channels that you no longer need, what's the impact to all the various new business, underwriting, customer service, the corporate units, and so those are all an important aspect of this. And really HR is critical and often becomes the driver, but it's only part of the equation to closing the block of business. Frankly, I've made every mistake imaginable in closing blocks of business, and I've made the mistake of making it too HR centric. And as Ernst Renner will shortly discuss, and I wish I had a guy like Ernst available when I've made all these mistakes before, is that you need to take a giant step backwards. And Ernst could talk about developing a scorecard approach where you methodically review in a disciplined and dispassionate way the risks and the rewards that are being sought. And too many times we focus on the rewards and we're not thinking about the risks. We don't even score the risks. We don't even score the rewards. And I think Ernst's approach is a really good, disciplined one that would be tremendously helpful. So at this point, the analysis has been done, and you are just about ready to go to the next step. And now I'm convinced that I want to close the block of business, and but what should I do? I want to close the block of business. Should I sell it? Should I manage it through a TPA? Should I keep it internally? One of the nastiest surprises that occurs is the difficulty to achieve the cost savings that you anticipated due to the simple fact that you hadn't thought through all the various options ahead of time. You only were focused on one, and that was really the cost expense reduction associated with less staff. But I'm here to tell you that managing a non-core block of business is a huge headache from nearly every imaginable perspective, but particularly from the HR and the technology side. Maintaining the quality staff to perform the critical functions that are needed often falls victim to the fact that the best staff find better jobs with a line of business that's growing. They don't want to be associated with a line of business that's being closed off. So you can put in stay packages, and those certainly work for short term, but they're not long-term fixes. What's really needed over time is to somehow retain the institutional knowledge that is quickly lost as the company offers incentives and early retirement to the very staff that in fact you want to retain, to teach the nuances and more importantly remember the nuances of why a certain business is being administered in the way it is. If a conversion were to take place later, and this has happened to me, there's a tremendous amount of difficulty you have in terms of trying to make that conversion happen, because the people who have the answers to the most difficult questions are the ones that are no longer available and at your disposal. That's why on conversions the bar has been set lower than it used to be years ago. The new bar for acceptable value matching on conversions is about 85%. In my opinion, that's absolutely crazy, as conversions should be really matching much closer to 100%. But the bar has to be set lower, simply due to the fact that the people with intimate knowledge of how the administration system was developed and customized over the years are not available to answer any questions. So hand in hand with retaining quality staff is that a system that might already be nearing its useful life will quickly become a legacy nightmare. And this is really one of the gotchas that you don't think about early on. But the cycle runs something like this. The company no longer wants to pay for upgrades on a system that's being maintained only for a block of business that's no longer core to the company and that you don't want to keep around. And so the software firm, on the other hand, is in the business of selling new and improved systems. And they don't want to maintain old legacy systems. And so their incentive is to try to move you to the latest and greatest system that they have. And they are adopting to their new technologies. They're upgrading their older systems to newer platforms. Well, guess what? Invariably, the company who decided to close a block of business and sought to reduce its cost by not having to upgrade its IT environment now finds that it has entered that dark void of maintaining a system that no longer is being maintained by anyone. And I've been there before. I've even had worse problems where not only do you have an issue on the software side, but the hardware which is used to maintain the product line is also nearing its useful life, and the manufacturer of the hardware no longer is going to be around much longer to maintain the hardware. And you could say, well, the after-parts market is available for that. And that's true, but only true for a period of time. And then you get into a situation where you may not even have spare parts for the hardware. Simply nothing that you had conceived possible when you decided that you were going to sell this or close this book of business. You were thinking and focused on the savings that you were going to get from the staff reduction. You weren't thinking that 5 years down the road you were going to have to spend millions of dollars to upgrade a product line that you weren't going to be maintaining and a system that you really wish you didn't even have to think about. So when possible, my thoughts are always to stabilize the closed block and then, if conceivable, to sell it. Of course, the market conditions for sale, they have to be correct, and the company must be able to afford to sell the block. And by that I mean with variable annuities, that's recently meant that a company may have wanted to sell their variable annuity business, but it wasn't possible since in the eyes of a prospective buyer the amount of capital that was supporting that business was insufficient. And so in order to sell, the company that was holding the variable annuity block would actually have to pay to the seller in order to take it. Not a very attractive sale opportunity. On the other hand, not selling a block of business leaves you two options. You can administer it in-house or you can outsource it to a TPA. And these options have different implications. We don't have time to consider all of them, so I'll just briefly touch upon the TPA option, which is often viewed as a panacea, but can be far from that. One of the benefits of TPA option is that it can allow you to administer your business perhaps at a little bit more reasonable cost. And I think that's true. I think that by and large the TPAs have as their core business administering other people's business, so they can retain perhaps better quality staff than you can. And that's an advantage. But that's because you have only thought of part of the equation. The part of the equation you're not thinking about is how am I going to train the TPA and do the knowledge transfer that's required. Well, I need all my staff to stay around. Probably need them to stay around for a year. To be honest, I probably need them to stay around for longer than that, because they not only have to train the TPA, once they've trained them, they have to oversee and monitor the TPA. Plus the business needs to be managed in a way that's consistent with the way you were already managing it. And of course, just because you have a TPA doesn't mean that you don't have to meet the state insurance department requirements, and they're going to have their audits and they're going to have their inspections, and they're not going to give you a break because you have a TPA. So they expect you to know as much about the business of being administered by the TPA as you do about your own business. So now I've come to the point where I really decide I want to still go the TPA path. I can't sell it at this moment. I don't want to administer it in-house, so I go visit my friends in legal and compliance, and I tell them what I'm thinking about. And I tell them how the CFO came to me and told me he was going to save me some money, and I told them how savings never goes out of style, and how excited I am about doing this. And of course they look at me and say, well, this is great, we'd love to support you, but did you think about data security or confidentiality? Like, how is this going to be administered outside of our intranet or outside of our environment that we have? What about oversight? You still have to have oversight of the staff. You've got some SEC responsibilities. You've got state insurance department responsibilities. Oh, and what's the errors and omissions coverage that your TPA is going to have? What about compliance reviews? We still have to do our regular compliance reviews. And that's when my eyes start to get a little glazed over, and they haven't even warmed up. I mean, they look at me and say, of course, you're going to have to take your time because this is not going to happen fast. And that's when I think it's time to think about selling again, because while I may not be able to do it right away, my next visit is going to be to my actuary. I'm going to ask my actuary, can you please help me value this block of business? And with that, I'm going to turn it over to Kiri, who can give us the actuarial perspective.
Thank you, Rick. Just want to talk to you about three things. One is maybe I should explain how I have been hired by different types of companies to, one, analyze or help them to determine whether a block of business should be closed or not. And two, some clients, I have helped them to sell the block or companies, or some clients I've helped them to buy a block or companies. These blocks vary from, they are not only life and annuity policies, but some of the blocks have been life settlement policies as well. So to start with, where Rick left off about the closed block of business, as Rick mentioned, there may be various reasons as to why a company may consider closing a block of business. It could be lack of sales, or high expenses, or excess required capital, or additional reserve needed to back up the guarantee. So there could be various reasons. But all in all, the bottom line is the company is not meeting the profit objectives, meaning they are not meeting the ROI. The ROI will depend on the risk that they take as well. So are they rewarded for the risk that they are taking? If it is not, that's when you start thinking of closing down the block of business. Rick also pointed out the fact that it's a very sensitive issue, especially when the recommendations are made within the organization. So there are possibilities where the people who recommend not closing down the business maybe because they are afraid to lose their jobs. So that's when some companies hire outside actuaries like myself to help them to evaluate the situation. So I have looked at some closed block of business, and I typically do not say to the company, oh, sell this block or keep the block. What I would do is come up with ideas as to under what circumstances they can meet the profit objectives. Oftentimes, I have zeroed on fixed expenses. It doesn't mean that you have to lay off people. You just have to be smart enough to figure out how to spend the money. I think Ernst has enormous experience in that field. I think he may mention that later on. So I'm going to leave that to the expert here. But oftentimes, the reduced expenses would trigger unexpected increase in ROI or ROE. Further, there are situations where you have no choice but to sell the block because, for example, one example I can give you is if the reserve is so low, it's not sufficient enough to support the guarantee provided in the group of annuity policies. As a result, your rating is going to go down. Then you have no choice but to sell the block. That's one example I can give. So there, it is hard to save that block. But most of the time, you can try to figure out how to keep it going. But if not, if you decide to close the block of business, as Rick mentioned, it's definitely a temporary solution, or rather short-term solution, because you cannot close a block of business and anticipate that you would meet the profit objectives when you very well know there will be lapses and deaths. So as a result, your revenue is going to go down one way or the other. So at some point in time, you have to face the music and get out of the block of business anyway. So at that time, if you reach a point where there isn't enough support system in your company, then you have to look for outside resources. So third-party administration or pretty much anything will be outsourced. Typically, that's what one of my clients is going through. Right now they are outsourcing all the jobs that is possibly outsourced. So moving on to selling the block of business. Once you decide to sell the block of business, if I'm representing a seller, my task will be as an actuary to value the block under reasonable assumption, and so that the seller can decide by looking at the retrospective cash flow and look at the potential sale price, the seller can decide whether it is the seller will attain its target profit objective by selling the block. Of course, the sale price is not only determined by the actuary, but it's also determined by the market conditions as well. So, so it is a decision that the seller has to make. It is possible that the seller may have to realize losses, and they may even consider how to benefit from losses on the tax side. So there's no guarantee that the seller will attain a profit by selling, but we try our best to help the seller to attain some profit. As far as the buyer is concerned, if I'm looking at the buyer will look at it as, okay, I'm buying this for a price, so that is that's an expense. Then we will look at the prospective revenue and expenses and see whether the buyer can recover the purchase price. If so, when, and can the buyer attain a target hurdle rate, whether it is 15% or 20% after-tax ROI. It's up to the buyer. So if the price is right, if the buyer thinks that they can attain it, it's good. Oftentimes, what I come across is the buyer often has an advantage in terms of systems or third-party administration system, or in terms of outsourcing capabilities. They will be able to cut down the expenses and grow the business because they know certain distribution system who can also help them. So, so when it comes to the IRR, so the buyer will determine the IRR based on purchase price and the future revenue less expenses. The seller will determine the IRR based on past expenses, revenue, and the sale price. In addition to that, I just want to mention to you, if you are interested in knowing how the value is calculated and defended, typically the value of a life block of business or annuity block of business is the present value of the future cash flow. What is cash flow? It's revenue less expenses, less taxes, less increase in capital. Of course, being a life insurance company, you may know that the taxes would be not all on the revenue minus expenses. It is measured against the increase in reserve, so the taxes are paid only if the revenue less expenses is in excess of increase in reserve. Now, in addition, we would also use some assumptions with respect to lapse rates and mortality rates, so that you cannot anticipate everybody to be alive forever in order for you to get the revenue. So once we determine the cash flow based on all this, we will take the present value using a discount rate, and that's how we come up with the value of a block. During this process, we also look at other risks, such as the products. What kind of risk the buyer would get. If there are products with a lot of guarantees, there will be additional reserve requirement, required capital requirement, depending on where the buyer is located. If the buyer is located here, yes, in this country, there's one set of formula for required capital. If the buyer is located in a different country, it will be a different formula. So all that will come into play in selling a cross block of business or buying a cross block of business. With that, I'm going to pass this on to Ernst.
Thanks, Gary. As we've seen from both Rick or heard from both Rick and Gary, 2/3 of the decision process is, and as it should be, is strictly driven from the business. My perspective is a little bit different. So in a lot of cases, I work with senior executives who, once people like Rick and Gary have made the decision that something has to be done with a block of business, and then some good thoughts on what could be done with those products, the next set of challenges down is what exactly can we do and are we capable of doing within our organization from both an operations and an IT perspective. The interesting thing is a number of clients, once they get to that point, what I've seen in industry is that an IT approach is typically taken to this, which is to say, I've made a large investment in a strategic platform, an administrative platform. Whether a product is open or closed, I'm putting it on that platform regardless. The issue with that is that that kind of, I call it an IT-driven approach, is typically very expensive. And it's not just the technology costs of moving the block into a quote-unquote strategic platform, but as both Rick and Kiri point out, it's also the operational costs and effort that go along with that movement. And at the end of the day, what I take out of both Rick and Kiri's comments is the cost of making that move. Is that going to be equivalent to the investment and the ROI that you're going to get if you keep things internal? So my point would be that for that one size really doesn't fit all in terms of taking closed products and deciding that we're going to keep them in-house or that we're going to sell them. That there's not always just one approach for all the closed product blocks that you have, that there's really a surgical approach that has to be taken if you have a portfolio of closed products. And that surgical approach lends itself to different options with what you can do with those products. More of a business-based, product-driven approach as a different perspective of looking at dealing with closed block business. One of the key principles to this is to take a scorecarding objective approach to assessing what's in your closed block or in a portfolio of closed block products. A lot of it is based on probably really pure business sense. So as we go through, it would make sense to do a lot of these things. It's not always just IT metrics that we're looking at in taking this type of scorecard approach, but since we're driven by product, we can look at different things like service events by product. There are some IT considerations in service events. There are an enormous amount of operational events and transactions that take place that feed into that metric. So service event by product itself is a big metric to assess, but those are broken down by exactly what's meant by a service event and what's involved in that service event. From being able to drill into those classic service event details, we can then drive to costs. And if we can base everything off of a number, as Rick had mentioned early on, if we can break everything into a number, we take out a lot of the, I'd say, emotion in the decision to what to do with a block, whether to sell it, whether to roll it into maybe a new product, whether to keep it in-house. You're taking the emotions out and you strictly have numbers then to deal with. Certainly not, probably not the end-all be-all in what you'd consider for a closed block and what you want to do with it, but it certainly helps to try to keep an objective frame of mind. Some of the examples on a service event, those on the call would probably, what do you mean by a service event? It could be anything from, fund exchanges to payout to claim to any time a policyholder has to call into the organization and all the piping and support pieces that go with that service event. So when we execute scorecarding type engagements, we have a predefined list of event categories and pieces that hang on to those events, and we work through those. They work for 90% of all life and annuity type businesses. The intent, again, is that once all those pieces all those metrics are collected, and we take that objective view, we have our numbers, we actually weigh the metrics. We put a weighting factor on these metrics based on what the business wants to achieve. So as Rick and Kiri point out, it may often be optimal to try to sell the block if market conditions and the disposition of the block put it that way. If that's really the strategic factor for the business, then that weight will have more priority in understanding the metrics than perhaps centralization onto a strategic administrative platform. And we consider all those and leaving them into how we assess our metrics so that we have a final disposition or a final position on the product block that's driven by the business strategy. So some of the features that, since this conversation really is about products all the way through, the biggest factor, and I think IT kind of typically doesn't really consider these too often, is the core complexity of the product. And underlying Rick's conversation and Carrie's conversation, we've talked about different methods of valuation. We've talked about aspects that would impact the valuation of a block. Getting down into the lower level, when we start to see what does it mean, what does product complexity mean? Carrie pointed out guarantees on blocks, big factor. But death benefits, loan provisions, what states are the products offered in? All the way to operational, go forward type impacts like the amount of testing and regulations that apply based on the licensing conditions or the situations that the products have been sold in. We need to take all that into consideration because from an operational point of view, each of those complexities or features, if you will, the product features even, compound themselves into either methods, business processes, or IT fixes to deal with those product features or benefits. So you could imagine kind of a simple picture of a Square as an admin platform, another one of your distribution channel, and the third of policyholders. Now, if we take that as a simple product, it may be as simple as that. But in a lot of cases, as we split out into different product features, more and more systems, both human and technology-based, add into that picture. So as we're creating this complex view, and because these products are typically old, we have added risk components or factors that have to be or should be considered in that view. The complexity factor is one from a technology point of view, but I think it's been repeated in each of the conversations. I'm going to repeat it again, but the people factor is a huge component of assessing the risk of what you end up doing with the block. So I've literally sat, and this is my most eye-opening quote that I had from a CIO at a very large organization. He's not worried so much that the systems are going to break down. He's worried that the people operating the systems are at such an age, he's worried about them not retiring, but them actually passing away. And once that happens, then your legacy knowledge is gone. And that, for me, was a real eye-opening type of quote, because it should be a concern for a lot of people that have been in the business for a while, that how these products are understood and how they're sold, how they're maintained within their IT infrastructure. It's this type of kind of hard stop that you run into. So you have to pick a final and good disposition for the products to make sense for everybody. There are a bunch of the other risk factors, and Carrie had pointed this out in terms of, in the context of selling the block, it's a matter of timing, and it's a matter of packaging, I think, what's around the product for optimal value if you decide to go to market with it. So the market conditions obviously make an impact, but sometimes it's not just the product that needs to be bought and sold. An acquirer would also look at what's surrounding the product. So proprietary administrative platforms that have been built to support a block or series of blocks of business, are those incorporated into the deal? Are the key people who manage those systems or operate the process upon those systems, are those included in the deal? Do we split those out? Do we divest things individually of the product and try to observe incremental value as we go through, or are we going through with the whole package? Those are considerations that, going through the scorecarding process, help to try to really prepare you to make a thoughtful decision. Just the act of going through the process exposes organizations into how much are we spending per policy when we file a claim? How much do we spend per policy on average on this product if we do a fund exchange? Organizations, from operations point of view, well, operations and IT don't often capture the same grain of monetary tracking on both sides. IT will have everything down to, a box, to a processor, to software, all these great dollars and metrics, and operations may or may not have everything, but they have it aggregated at probably a service event level. What we have to do is bring those together. When we bring those together, we get a complete picture of what the true cost of running this portfolio of products is to the organization. By going through this and to make a good and fair assessment, we have to really look at all of those costs holistically. We shouldn't look at them independently. And I guess maybe my theme is that in a lot of organizations, these costs are looked at independently of each other. So there might be a decision to sell a block, which is fine. Operations will have its view. IT will have a different view. And sometimes it becomes really difficult to put them together and understand what's the true value or cost of what we're doing with this closed block. I think the last points that I wanted to bring out around gotchas, and I think this is almost post-decision, going back to one size doesn't fit all. So one of the gotchas is that 3 really clear outcomes for a product would be to sell it, to TPA it, to keep it. Underneath those, there's different options of how you might want to implement it. So going through a process because once you make one of those decisions, the next decision is, well, how you're actually going to do that. So if you keep it, for instance, do you throw everything that you have onto your strategic platform that you've invested millions in? Or can you do something else with it? I almost encourage, I do encourage IT executives to look at things as lowbrow, if I might say, as maintaining the business out of a box if they need to. You can see product blocks that may have only very specialized product, may only have 30 policyholders in it. So what do you do with that? Is that worth the investment of customizing a WMA implementation, for example, to support this product with a bunch of product features in order to support 30 policyholders? That's maybe an extreme example, but you have to look at the metrics and the usage of the products as well as the features. So the gotcha there is that whether the complexity and the size of the product block and the demographics of its policyholders should be a guiding principle into a practical decision from an IT side of how to support it if you're keeping it in-house. The other aspect of the TPA channel, for example, well, how are you going to set your organization up to actually leverage the TPA the right way? You do have to do a fair amount of preparation internal, I think, before you want to hand over that level of service to a third party. And before you even get ready to do that, you have to ask yourself how, maybe you're back to my service event example, I guess. What degree of service do you have to provide the policy or holder base in a given product block to maintain your high level of quality customer service standards? Is that something you're comfortable giving to a third party, or are you not? So another decision point along those lines. And the third, around selling a block, the prep work that is done at the operational and IT level in assessing the disposition of these blocks also becomes extremely effective when that final outcome is to sell the block. And the reason is that all the different pieces that you look at to assess what needs to be done with the block is exactly what an acquirer's operations and IT organizations will do as well. They're going to look at how things are interconnected, who's working on the processes, how's history being maintained. All these things that we would look at in a scorecarding process are exactly what an acquirer would look like when we're in their valuing or trying to understand how to bring a block in. So all in all, it's probably a healthy effort, if not already gone through by many of you on the phone, to do this type of exercise. I think the last point that I want to bring up on gotchas is typically there's it's either a 1 or a 0 on the IT side on overcomplicating the amount of effort or overestimating the amount of effort to deal with interfaces and exchanges within systems internal to the organization as well as external, or the total opposite, a huge estimation of time and effort to deal with interfaces and exchanges between systems. Many organizations through the years, the past 40 years, have built customized exchanges to deal with certain triggering events. Commissions may not be as big a factor in closed block business, but always a good example about dealing with certain payout options or commission options to agencies or brokers when they've hit certain thresholds. All these things get compounded. So when I mentioned before product features radiating out into levels of degrees of complexity, those degrees of complexity are manifested in interfaces and exchanges. So for me, those are the couple that I had thought about in preparation for this. With that, I think I'm done.
Great. Well, thank you, Rick, Kerry, and Ernst. Before we get to questions, just a quick recap of some of the scorecard information that Ernst talked about. It is a helpful first step in creating an overall modernization roadmap and looking at all the different options available, as you said, underneath some of what the highest level options might look like. And although the NEO scorecard is a consistent process, it's very heavily customized by the business and technology drivers specific to a company and the product that that company has on the books. So we do have some questions from the participants. One that came in ahead of time is more of a statement than a question, and I guess I would, I'm not quite sure which of you wants to take this. It's about compliance. How do you stay compliant with a closed block, especially in the group plan space? So as you keep closed blocks of group plans on your books, how do you keep up with the changes in compliance, the testing, the reporting, the different requirements? I think Kerry looks like he wants to answer, so
okay.
We'll let Kerry go first.
Kerry, the actuary, is going to talk about compliance, which is a legal issue, which is okay. If it is okay with Rick.
Rick, do you want to start with that?
Kerry, please go ahead and start.
Yeah, the compliance, you cannot really get out of compliance as long as the policies are in the book, in your books. Whether it is closed or open, you do have to comply. There are various compliance issues will come in. There are state laws and federal tax laws, and sometimes SEC laws as well. There are, God forbid, in the insurance industry, there's more than enough regulations. But I don't see a way out of compliance unless you somehow pass the liability to a financial reinsurance company and pay somebody and have them have you indemnified from the compliance. But then again, you're going to encounter having to pay somebody to indemnify you. So answer to your question, unfortunately, you do have to comply with all the federal and state tax laws as well as other guidelines from SEC and other regulatory bodies.
But outsourcing is an option if you don't want to try to maintain that competency in-house, but you are going to pay for.
Yeah, you do have to pay for it.
Okay. Rick, is there anything you'd like to add to that?
I guess you can through maybe a co-insurance arrangement or assumption reinsurance arrangement. You might be able to transfer liability, but really the regulator, that's a contractual transfer of liability. The regulator is looking to the primary writer of the business, and they are much less interested in whether or not you have an indemnity from a third party. It's still, if it's written on your paper, it's your liability. It's not going away.
I think, from my end, Rick and Kerry are experts here with this, but I would just say, it goes into the metrics and the cost of the block. So depending on the features and on the state of issuance, right, that really goes into the total cost of the product itself. And again, would probably want to be those driving factors of what you do with the block, whether you sell it or whether you TPA it
or co-insure.
Or co-insure, right.
I think we have a couple questions that seem related. Someone's got a closed block of business that they would like to sell, but don't think that it is attractive. They're making kind of an internal assumption it's not attractive enough to be bought, and the effort to make it attractive might be costly. Any advice on making that determination, what their options might be?
That's a Rick or
That
Gary.
sounds like a Rick question to start with.
Well, actually, I mean, I can start off. I would turn to Kiri quickly, but you have to start off in understanding. I think we touched upon this earlier. Ernst did. He was talking about you got to get to the true cost. You have to understand as you're building out any valuation model to make a determination as to what the right path is. You got to get down to the true cost, and you have to not be satisfied with just the superficial costs that you see, but you have to get down into the details and try to make it as much as an integrated process as possible at arriving at a good cost. And then, Kiri, perhaps you want to talk a little bit more in detail about the valuation analysis that would take place.
Okay. Yeah, I can tell you my current experience with a small closed block of business is way too small to be attractive enough for a buyer. So, by the time you spend time and money analyzing the block, you may find out that the value of the block is less than what it costs to analyze, or at least do the valuation. So that's a tough one. So they are the best the company can do is, for example, in this particular case, I'm involved in this, so I better tell you what's really going on. What I did was, I agreed to charge a fee based on the assets. That way, the company can always recover its cost. So as it dwindles down, of course, my fee will go down also, but at least I'm taking care of managing the block right now as it dwindles down. But once it becomes too small, it's pretty impossible to sell. I can give you an example. If the block is worth only $100,000, why would anybody want to even spend money on an actuary to value the block for $200,000? That doesn't make any sense.
Okay. Again, another related question. Is there a critical mass or a minimum block size rule of thumb before outsourcing makes sense to offset cost? Is there either a volume number or a dollar number that you would use as a rule of thumb?
Yes. Actually, it is possible to solve for the critical mass that you're looking for. It depends on the revenue and expenses. Mm-hmm. Then you can decide what it should be in order to sell.
You don't have one in your back pocket that's like $500,000. You're
no, that would be way too subjective for me to say.
True actuarial answer. Okay.
Always constrained, Kiri. Yeah, I guess, Kiri, you're always constrained when you're considering whether outsourcing makes sense by the pricing assumptions that you've made for that block of business and what your expense allocation is for M&E. And so I think one of the decisions that really factors into it is to be sure that you're staying within that M&E guideline that you've set up in your pricing assumption. Otherwise, it's going to fundamentally change what the value is for the block.
That's right. Yeah. M&E stands for mortality and expense risk charge. It is essentially an asset load built in the pricing. Okay.
Okay, and then a couple questions that came in while Rick was speaking early on. Rick, are there any best practices for knowledge transfer? You mentioned critical institutional knowledge, documenting that information. Do you have any best practices you can share?
Well, the best practices in terms of knowledge transfer, there have been some studies that have taken place, and there are a few organizations that develop metrics along this line so that you can go back and take a look how you're comparing with respect to how your the industry competitors are doing. And so that's certainly one basis for doing that. I mean, you can also be doing what has been suggested by Ernst, and that is to develop a good scorecard, because ultimately each one of these are each one of these closed blocks are unique, and the circumstances are so different. So making broad statements and comparing yourself to industry standards, while useful and relevant, is at the end of the day not necessarily applicable to your situation. So I would think taking your time and developing a detailed scorecard would be the best approach. There's a lot of metrics out there that will help inform you as to what are some of the risk factors that you should be measuring and putting inside your scorecard.
Okay, thanks. And then, Ernst, how do offshore service providers fit into the closed block marketplace, if at all?
Yeah, that's a really good question. It's funny that Carrie and I were actually talking about it at lunch prior to the meeting. So I'm going to use Carrie's answer and say it depends, but it does depend on kind of the overall cost and value. But I would say that the number one consideration I would have in using an offshore provider is the level of service for holders of that product. So if it's high value product, meaning high premium amounts, therefore you're going to have I don't want to say high maintenance, but a high level of service required by the policyholder, then offshoring the service of that block doesn't make a lot of sense. I think it's too risky. Low volume, low premium or face amounts and easier products lend themselves better to a lower cost, offshore alternative for service. Now, Gary, do you have anything to?
It is possible, depending on where the company is located, the company that is providing the services, the licensing requirements for third-party administration company may be easier in the offshore and less bureaucratic, and auditing requirements may be less restrictive compared to U.S.-based service providers. But then when you say offshore, I don't know whether you're talking about Cayman Islands or Bermuda or Virgin Islands or Ireland or Guernsey. I have no idea. So, but it really depends on the location of company.
I simply would add to that if you're going to be administering a U.S. block of business, policies that you need to be approved by the local state insurance department and be a licensed TPA. So it's not very easily accomplished offshore. There are discrete functions that can happen offshore, like in India and the Philippines are the two most popular offshore locations for most of this offshore business. But the kind of business that they are handling offshore are not ones where they need to be licensed for inside the U.S. by a local state.
Thank you. I think that's the last question we have time for. In summary, just a few points that we hopefully have covered. Stressing that this is a business strategy decision. Think of your product portfolio holistically. One shoe does not fit all. I think Ernst made that point pretty clearly. Need to consider the different characteristics and come up with an approach. Do this surgically, do this intentionally, and adapt to your business strategy. So thank you all for joining us. NEOS did sponsor this webinar, and we'll be sponsoring additional webinars on a variety of topics. We hope the webinar today has proven valuable to you, and you'll join us for future discussion topics. We will be sending out a survey to ask for your feedback and any suggestions you might have on topics for future webinars that are of interest to you. And everybody have a great day. Thank you very much, Rick, Carrie, and Ernst.
Thank you. You're welcome.